Welcome back to Soar Financially. My name is Kai Hoffmann. I'm the CEO of the Soar Financial Group and your host for this discussion today. Really looking forward to it. Again, there's lots going on in the markets and on a macro, micro, and global scale, obviously. And we've invited an interesting guest because he looks at it from a very different perspective than some of our other guests that we had on recently. He looks at it from an Elliott wave trading principle. He's going to explain what that means because I need some explaining as well because I'm curious. I'm not an Elliott wave or technical trader, but I love the perspective because it puts numbers, charts, and everything into different perspective as well. His name is Murray Gunn. He's the head of global research over at Elliott Wave International. And Murray, it's great to have you on the program. Thank you so much for joining us.
It's great to be here, Kai. Thank you very much.
Yeah, no, I threatened you in the beginning. It's like, you need to introduce yourself real quick. And of course, the Elliott Wave principle and how you guys operate before we dive into a lot more specific discussion here.
Sure. I'm Murray Gunn. I'm the head of global research at Elliott Wave International. And I've been in the financial markets now for well over 3 decades, been through a few cycles in that time. And I started my journey as an economist. And like most people who come into technical analysis, they start looking at the markets from a conventional point of view and then realize that actually the markets don't behave as we're all taught, in the economics school. And that led me down the road of technical analysis and into the Elliott Wave principle. And I started reading Robert Prechter's work in the early 1990s, and it really resonated with me straight away. So, the Elliott Wave principle is the model we work off, and it's named after a man called Ralph Elliott, who was an accountant for most of his career. Lost a bit of money in the 1929 crash, and putting his accountant's brain to it, wanted to find out exactly what had happened. So he did an empirical research on the US stock market, and he got all this data and didn't come to it with any sort of preconditioned biases, and just found out, and he discovered that the market actually moves in a series of patterns which are repeatable. He called these patterns waves, and he discovered that the patterns repeated at every time scale. So what we have is what we call a robust fractal model to work off. So from a very long term to the very, very intraday price action, these patterns will repeat. And he also discovered that the patterns are related to each other by natural mathematics based on the golden ratio 1.618, which is ubiquitous in the world. So that's our model. We within that, there's lots to talk about in terms of how it's related to psychology and sentiment, and how that drives the markets, which really is all about what Robert Prechter then developed his model of his hypothesis of socioeconomics, where it's actually social mood that is the main driver of everything, of course. And so, people ask us sometimes, why do we look at patterns in the markets and technical analysis? It's because the markets are driven by human beings. So price patterns bring out the human element, and that's why we study human being behavior.
Interesting. Yeah. Interesting. Like you mentioned, you're an economist. My brain immediately went to emotions. Okay. And now I do it as well. Like I look at sentiment a lot as well, especially in the junior mining space where we come from. And I look at emotions is dictating a lot of the chart movements, right? So as an economist as well, like how do you avoid throwing emotion in there? It's just purely technical, right? But aren't you a little skewed towards the emotional side of things as well?
Personally, very much so. In terms of analysing the markets, very much so. Identifying that it is emotion and sentiment and mood that drives the markets. But every human being as an individual is not immune to feeling the emotions that we all feel when we're involved in any investment in the market, for sure. And but that's why it pays to look at things from an objective point of view, such as technical analysis and the Elliott wave principle.
No, fantastic. No, I appreciate that introduction, Murray, because I think it frames a bit of the discussion of where we're going to take things. Because your slogan on the website is expert market forecasting, and let's see if we can achieve that here today, and to talk about a few things in the end, ending with gold and silver. But I think there are a lot of factors flowing into the gold and silver price. So let's zoom out together just a little bit and talk about what is happening on a global scale. And maybe you can share with us like some of the chart patterns you're looking at right now that are most intriguing to you as well. Like I have a few ideas probably, but I'm curious from your point of view, what is one of the most interesting chart patterns right now?
Well, the one that really springs to mind is the Chinese stock market. A lot of people don't realize that in the last few decades, it's really only been the American stock market that has held the global economy together and is going up. Japan topped out in 1989. It's still well below its 1989 high. Europe basically topped out in 2000. And the German stock market on a price basis is only just slightly above where it was then. And Italy and Spain are well below where they were in 2000. And the Chinese stock market topped out in 2007. And looking at the Shanghai Composite, and the price pattern we're looking at in the Shanghai Composite since then is what we call in Elliott wave terms a triangle. So it's a sideways movement, and that essentially means that it's a bear market. Stock market going sideways is a bear market in real terms. So it's been driven by a negative social mood. Every bear market is driven by a negative social mood, and that's why we can use the stock market to identify what the mood is. So we're coming into the sort of latter stages of this triangle, and why is it interesting? Because we had a very similar situation pattern in the Russian stock market, which enabled us at the start of 2022. When people were wondering whether Russia was actually going to invade Ukraine, we published and advised our subscribers that because of this pattern in the Russian stock market, it was very highly probable that Russia would go in because it was driven by such a negative mood. And at the end of these triangle patterns, negative social actions can result. So looking at China now, it's interesting that there's a lot more talk about Taiwan and what might happen there. So it's really we're closely watching the Chinese stock market at the moment.
Interesting that you went directly to China and Russia as well, because a lot of guests I have on the program as well, it's very US-centric discussions, very US-focused, being it the Fed, US dollar, or even the S&P 500, right? So really, really interesting, because I think China has a lot of influence on what's happening globally. So in your opinion, what is driving the markets in China right now? Like, where's the interest coming from? I'm just curious, like what it has to do with, because I'm hinting at the Chinese yuan here and how it's gaining strength and maybe importance as a global world reserve currency or as a global currency. Let's not talk reserve yet, but as a global recognized currency.
Yes, well, I mean, there's obviously no doubt that that's the sort of end game that China want to get to. I mean, everyone quotes the famous quote about the Chinese. I think it was the Chinese premier at the time back in the 1970s, and he was asked what he thought about the French Revolution, and he said, "Well, it's too early to tell." So it's the Chinese famously take a very long-term view, and undoubtedly their goal is to have the yuan as a significant reserve currency, if not replacing the US dollar. So, that's what's driving the Chinese market, what's driving the Chinese economy. International investment in China is still, debatably not as high as it probably will be in the future. So there's that to consider, as well. But really it's just this idea of negative social mood manifesting in a sideways stock market, which is pointing to something happening on the negative social action front in the future.
Interesting. So you see that triangle pattern forming again, and I'm not sure which way the triangle is pointing, but I'm guessing the pointy end will be when something happens. Is that correct?
Well,
I might be wrong. So,
without getting too technical, triangles occur in 5 waves, A, B, C, D, E, and it's the E wave of the triangle when it's culminating in the pattern. That's often where we find that the negative social actions can occur. So, at the moment, where it's we could be there, but we might have to wait a couple of years to be in that situation.
You're saying we're stuck between D and E right now, sort of? Is that...
We're kind of between there, yeah.
Interesting. Okay. Because you also track global money flows. I just want to follow. I don't want to spend all our conversation, obviously, on China, but it is important. And you track global money flows. And you said it's not really, or you haven't seen a lot of global inflows of capital into China. Is that correct? Or am I paraphrasing here the wrong way?
Yes, that's absolutely right, and I think one of the broad themes that's going on at the moment is this idea of deglobalization, and it's pretty clear now that's a trend. The world's polarizing, and that in itself is a sign of what we call a negative social mood that's coming through. When social mood is positive, people come together. When social mood is negative, people grow apart. And so that's another reason why we are thinking about a global recession in the not so distant future. But that's driving the capital flows at the moment. So money is tending to be coming back to home countries rather than going out internationally.
Okay. Let's zoom back to the US. I want to come back to global recession in a second, because you're also one of the first guests to mention global recession. Whenever I talk to our guests, it's always a recession in the US, not really anywhere else. It's so US-centric, all the discussions. They're still an empire, although I had some guests on recently that said, well, the end is near of the empire. So I want to bring the discussion back to the US a little bit. We have to. But this week we had the CPI print as well. And my question now is what does that mean moving forward for the US dollar, the US economy? We're at 4.9, slightly under expectations as well. So bring that back into the whole macro context. It's a big question. It's a loaded question, I think, as well. So what does this week tell you?
Well, yeah, it was interesting that the CPI headline printed below 5%, and you'd think that the markets would rejoice. There would be, a lot of pleasure about that, but the markets really just kind of shrugged, which sort of tells me that perhaps there's a bit of CPI fatigue coming through in people's views of the market. Our view, of course, is that none of these statistics drive the markets. We look at it completely unconventionally. We pay attention, obviously, to what the numbers are saying from a sentiment point of view. But if you look at so everyone looks at what's the CPI doing and what does that mean for the Federal Reserve or central banks in general, and we've shown charts over the decades to our subscribers that prove pretty much that whereas everyone thinks that central banks lead the markets, it's actually the markets that lead the central banks. So the money markets and the short end of the bond markets, they move first before the central banks like the Federal Reserve move interest rates. So a classic example was just what happened, over the last couple of years, where the short end of the bond market in the US was zooming higher, and the Fed was doing nothing, and eventually the Fed had to follow the bond markets. And so what's going to happen in the future? Will the Fed pause? Will they still continue to hike? We're focused every day on what the money markets are doing, what the bond markets are doing in terms of predicting that. at the moment it's kind of 50-50. You've got the short end of the money markets pricing in cuts, but the 2-year bond yield is still looking like it wants to go higher. So it's kind of 50-50 at the moment. Certainly what Chair Powell is going to be afraid of is what Arthur Burns did in 1974 and cut interest rates. And we think that the pressure will be there for him to do that. Perhaps the bond markets will lower yields because we see this the stock markets lower and over the next few months into next year, and that will lead into a US recession. I mean, it would be a miracle if there's not a US recession. If you look at one of the best indicators is the yield curve, and that's been inverted now for a long time. It's a very extreme inversion, and historically, when the market starts to normalize, when the yield curve starts to normalize, that's when a recession normally starts. And so it would be a miracle if there wasn't a US recession based on that indicator.
Yeah, interesting, because we're finally seeing some real yields again, because the inflation rate is barely below what some of the treasury bills yield. So there's some real yield to be had again. Is that the start of the recession here? Should we start marking our calendars?
Well, yes. I mean, we could be very close to it just as we're coming into. I mean, one of the things is employment. The labor market it's lagging. It's a lagging indicator. I mean, the last thing that firms want to do is lay people off. So that's why the labor market lags. And of course, unemployment is at historical lows. But again, you've got to take that sort of contrarian look at things. If unemployment's at historical lows, then the probability is that it's going to rise from here. And so that's another reason to actually expect, or anticipate a recession. But in terms of, having a yield back in the markets, yes, that's, another reason why the kind of equity culture that's been brought up over since the 1970s, this idea that equities were the be all and end all, that's now we're moving away from that, and you can get a good return in T-bills, and you can, if you pick the right credits, you can get a good return in the corporate bond market. So it's another reason to expect a move away from equities.
Interesting. Like one thought that popped into my head is a liquidity crisis that's happening as well, because you were talking about jobless claims, jobless rates. One issue I see as well is that small businesses won't be able to either get new credit or even extend existing loans or extend existing debt, because all of a sudden the rates are just astronomical, because now we're talking, let's say 6%, or like in mining, it's usually LIBOR plus, right? So LIBOR plus 3, plus 4. So all of a sudden we're talking 10% interest again. And that's the base case, right? So how does that factor in? And when do you see that trickling through, that liquidity crisis that's, in my opinion, getting worse?
Very much so, yes. The recent banking wobbles, crisis, whatever you want to call it, has obviously exacerbated things. But the trend's been in place for, a couple of years now, at least since the bond yield started moving higher in 2020. But yes, I mean, one of the things that's kind of been a little bit of a surprise for us is the fact that the corporate bond market has held in quite well. I mean, of course, yields have risen in nominal terms, along with all yields. But if you look at the yield spread to US Treasuries, so whether their corporate bonds are outperforming or underperforming, they've actually held in relatively well. They've underperformed slightly, but they're nowhere near, the yield spread is nowhere near the levels it would be in a recessionary environment. And perhaps one of the reasons for that is the fact that when the COVID pandemic lockdowns hit and central banks reduced, and the Fed reduced money to nothing, or interest rates to zero, and created a sort of money for nothing environment. Corporate treasurers took advantage of that and raised a lot of money at that time. And so that means that the bonds that they have to roll over haven't really come due until now. And so it's really the sort of end of this year into next year that there's this wall of corporate debt rollovers that's going to happen. And so, I'm sure a lot of corporate treasurers are looking at that with a lot of, fearfulness and thinking that, yes, how are we going to manage to finance this at much higher rates? And so I think at the end of this year into next year, that's when we'll start to see the corporate bond market crack finally.
Now, there's also questions, interesting point you mentioned corporate bonds, because I think Newmont financed, I think it was I might be wrong, but $1 billion worth at 4%. And that's maybe 18 months ago, 24 months ago, roughly, right around that time. So sort of the treasurer is forecasting what is happening, I believe. But I was also thinking of the small businesses, the family-run enterprises that are dependent on credit to keep their business going because they need supplies and whatnot. That hasn't really hit yet. I'm a bit surprised. When I look at the jobless numbers, for example, all I hear in the media is, is the big tech companies laying off people they overhired during the COVID pandemic. Right? Are you seeing any trends there yet for the smaller business? Because I think that's where it will hit first, don't you think?
Well, we see small business confidence from the surveys. That's certainly coming down. But these things take a little bit of time to come through. As loans have to be refinanced, etc. So there is, we have such a fast move up in the short end of interest rates, whereas the 5-year, 10-year bond yields had been moving up since 2020, but really it was only last year that the Fed raised interest rates very, very quickly, and so that takes a bit of time for to manifest itself in loans and finances for individuals and small businesses. And so we can see that effect probably coming through now. I'm speaking here from the UK, and we have a situation where people do fixed rate mortgages for maybe 2 or 3 years, and so now people have to sort of roll over these mortgages and are finding that whereas it was 0.5%, now it's 4% or something like that. So it's it takes a bit of time to feed through.
Yeah, absolutely. Interesting. Let's talk US dollar real quick. It's a massive topic. Real quick is an understatement, I think. But the US dollar is hanging in there at 101. That's the Dixie I'm quoting here. And it seems surprisingly strong for now, but it's also weak in comparison to where we've been already in October. So I'm curious, how is this all affecting the US dollar? And a question I asked one of my panelists recently was, is actually a weaker dollar better for the US? Meaning a weaker dollar better for the US dollar in the discussion of world reserve currency status? Because a lot of foreign countries are selling their sovereign debt back, more or less, during a phase of strong dollar. And now, at least that might have slowed down. Is that I went on a tangent here mentally as well. So my question is, how is the US dollar doing, and what are you forecasting? Could have asked that.
Sure. Yeah. No, it's. Obviously, the strength of the dollar that we've seen, recently has not helped emerging markets. For instance, it's kind of generally a kind of deflationary element of strong dollar because most of the debt in the world is denominated in dollars. From a Elliott wave point of view, we're at the moment looking at what we call a wave count, so the labeling that we put on the patterns in the Elliott wave in the prices. So thinking about strictly euro-dollar, which is the inverse of as you mentioned, the DXY, we're looking at a situation where euro-dollar is probably starting a long-term advance. So a weaker dollar over the medium to long term. In the short term, i.e., the next few weeks, months, we might expect a slightly stronger dollar, which could kind of tie in with a weakness in the equity markets and more of a sort of risk-off environment. So the question is, I mean, what we're looking at from a Elliott wave perspective is, if we're looking into next year, we're looking at stock markets that are weaker, but also a weaker dollar. And a lot of people look at that and say, well, that probably doesn't actually correlate, because if there's a risk-off environment, then people rush to safety, they rush to the dollar, and that's what probably will happen. But what we try and we never actually start our analysis with correlations. We look at each individual market on its own merit and let the correlations drop out of that. So perhaps what is being anticipated by our Elliott wave analysis is that we have a situation of a recession environment, weaker stock markets, and people, because the US stock market has outperformed for decades everything else, that people actually now think that maybe the foreign markets are more value than the US.
Interesting. Okay, you said you don't correlate from the get-go, but I want you to correlate, because now let's take the US dollar chart, and you're expecting a bit of strength over the coming months. What does that mean for the gold price? Because usually they're negatively correlated. Usually the one goes up, the other one goes down. Yes, there are cases when they go up and down together. Generally speaking, they diverge. So curious what that means, and brings back one of the titles. I think one of your videos on the website says, sell in May, go away. Are we coming back to that old saying as well? I'm curious what you have to say there.
Yes, actually, the origin of that phrase, "sell in May and go away," there's the last part of it is, "and come back on St. Leger Day," which refers to a famous horse race here in the UK. And so, yeah, it dates back from the time when people in the city of London, in Europe, would retire to the country for the summer, the Northern Hemisphere summer. And so it was generally a bit of a lull. And interestingly, if you look at the historical stats, it does actually suggest that there's a lot of merit to the fact that there is weaker stock markets on a relative basis in the summertime. So, but looking specifically at our Elliott wave patterns at the moment for the stock markets, it really kind of ties in with that now, and the fact that, yeah, selling in May for assets and going away is probably going to work, this year. In terms of the gold price, what we're looking at is from the low of, I think it was 2016 low, we're looking at the advance since then as what we call a fifth wave. And so that means it's the final wave of the rally. And we're coming into what we call the fifth of the fifth advance in that rally. And yes, there'll be, there might have a little bit of a sideways to down movement as the dollar strengthens, as we are looking at for euro dollar. But in general, the gold price is in this sort of fifth wave rally. And that's interesting because in commodities and metals, fifth wave rallies, when these prices are going up, whereas in the stock market, the sentiment behind an advance in the stock market is greed. The sentiment behind an advance in metals or commodities tends to be fear. And so that's one reason why fifth waves in metals and commodities can actually extend further than a lot of people think.
Interesting. Yeah, I like positive words. It's we need some hope here, because it feels like sentiment for gold, despite all the macro events that are happening, is still, I wouldn't call it bleak, but subdued maybe, right? So it still should be way more euphoric based on what we're seeing, because we're trading almost at all-time highs. So I'm curious, like, how that fits in. Like you're nodding along here, so I'm curious, like, what does that mean? Like, why is sentiment so bleak? Are you tracking that as well? Is that do you have a factor for that?
Well, it's a good point you make because it's actually in the fifth waves. And as I say, we're coming into the sort of fifth of fifth. That's when you start to get the interest in it. A sort of speculative, historically in stock markets and the gold price. Back in my memories, if my memory serves me right, I think it was 2014 when we had the big spike. But you had so many positive gold stories there, and everyone, coming out. I think the famous quote was someone said that you had to be, mentally unstable if you didn't have gold in your portfolio. And of course, at that time, these are the sort of sentiments we look for tops in the market when everyone thinks it's a must-own market. So the fact that there isn't such a huge amount of bullish sentiment towards gold at the moment probably suggests that it does have it further to go.
Perfect. I like hearing that. I really do. What about silver? Silver is like, gold's little brother, but it's trailing behind. Year-to-date performance is less. Today, as we're recording, it's brutally underperforming gold, and we're recording this on May 11th. Gold is flat, silver's down 1.5%. Do you have an explanation for that as well? And what phase are we in for silver?
Well, the wave count is pretty similar for silver, so it should advance, with gold, but probably continue to underperform. And it's an interesting, aspect, the fact that it is underperforming, because traditionally, historically at least, when silver has been underperforming gold, it tends to be indicating that there is some, economic weakness ahead, given that silver is more of a manufacturing metal than gold. So that the underperformance of silver will certainly ties in with our Elliott wave analysis in terms of expecting weaker stock markets and a declining or slowing economy into recession.
Since you brought up the economy and correlated with silver, I do have to ask, and Dr. Copper, how right is Dr. Copper these days? Because again, as we're recording this, it seems like it broke a little resistance to the downside as well. What do you see there, and how is that an indicator for a possible recession coming up?
Yes, certainly the industrial metals will be leading the economy lower. So we see, as the recession develops, then demand for industrial metals will certainly ease off, and that will affect copper and nickel and all the industrial metals. So we should see some slumps going on there as well.
Yeah, no, not fantastic, but we are seeing it right now. So I think we're heading somewhere big. And you mentioned it. It's going to be rocky. It's not going to be straightforward, I think. So weaker dollar, slightly stronger for short term, weaker longer term. Opposite, I think, for gold. And really curious how that plays out. Marie, where can we find more of you? It's extremely insightful conversation, but I know you have lots more content to share. Where can we find more of you?
Well, if people want to find out more about the Elliott Wave principle, elliotswave.com is our website. And in terms of social mood, socionomics.net. That's not socioeconomics, it's socionomics.net. And those you'll find a huge amount of very interesting stuff on both those websites.
Fantastic. Murray, I tremendously appreciate your time. Super insightful conversation. And we hope to have you back on maybe in 3 to 6 months, somewhere in between there. We'll see where we're at, maybe after the summer, to see if going or sell in May, go away was the right thing to do.